Good afternoon, everyone, and welcome to the History Forum. I'm Annie Johnson, the museum manager here at the History Center. Today we welcome Julia Ott, Associate Professor in the History of Capitalism and the co-director of the Heilbronner Center for Capitalism Studies at the New School for Social Research and the Eugene Lang College at the New School. She is the author of When Wall Street Met Main Street, The Quest for an Investor's Democracy. Ott specializes in economic history and political history. In her teaching and in her published work, she investigates how financial institutions, practices, and theories influence American political culture and how, in turn, policies and political beliefs shape economic behavior and outcomes. Please join me in welcoming Ms. Ott to the History Forum.
Hi, everyone. It's great to see you. It's great to see a nice crowd, getting a little bit more back to normal with some group engagement after so long of being isolated and virtual and all of that good stuff. Want to thank Annie and Danielle and all the staff here who have been so kind to invite me and to make this such an easy, pleasurable, well-supported event. So picking up a little bit on Annie's introduction of me and my work, I will observe as a historian that for over a decade now, Americans seem to have been limping, sort of from crisis to crisis. The housing and student debt crisis precipitated by the 2008 financial crisis, the political and racial and human rights crises of the Trump administration, the public health and social well-being crisis precipitated by the COVID-19 pandemic. As we've muddled and struggled through these successive crises, as crises have become, or crisis has become perhaps a permanent state of affairs in our national life, Americans have been growing, I think, increasingly aware and critical of inequality, of capitalism, and of finance as those things currently exist in our world. This strikes me as quite a change since the halcyon days at the end of the 20th century, as the 20th century turned into the 21st, when communism lay vanquished at the end of the Cold War, as the dot-com stock market and the housing markets were booming. We, as Americans, were not, I think, as critical as we are today of inequality, of capitalism, of finance, not as keenly as aware, not perhaps asking more of our political leaders, about the current and contemporary configurations of these things as perhaps we are now today. It strikes me also as a historian that Americans may be, in their perspective, expressing something or asking something similar to where we were at the beginning of the 20th century, so 100 years ago. Americans today may be regaining that older skepticism, as I said before, about inequality and capitalism and finance. This was a skepticism that was sort of broadly held before the period of time that I'm going to talk about today, which is the period of time in the beginning of the 21st century when, as I call it, Wall Street met Main Street, first met Main Street. That is, average Americans, call them retail investors, began to entangle themselves with the financial system that we call Wall Street. So this may be a quote that seems familiar to some of you. Oh, wait, did I lose my quote? Oh, there it is. Have you guys seen this quote before or sort of heard something along these lines? Okay, we can have democracy, a democratic society, or we can have the concentration of great wealth in the hands of the few, but we can't have both. This is a quote that has popped up, over the last decade or so time and time again, and usually it's attributed to Louis Brandeis, the Supreme Court justice who cut his teeth as a public interest lawyer at the beginning of the 20th century, was part of Roosevelt's brain trust, and joined the Supreme Court under Roosevelt. This isn't actually, I don't know how the actual quote turned into this quote. This quote is sort of nice and pithy. The closest quote that we have that actually came from Brandeis is this one, which is far more kind of complex and dense. The gross inequality in the distribution of wealth and income, which giant corporations have fostered, that by the control which the few have exerted through giant corporation, he needs a comma here, individual initiative and effort are being paralyzed. Only through participation by the many in the responsibilities and determination of business can Americans secure the moral and intellectual development which is essential to the maintenance of liberty. That is, political freedom, democratic citizenship. So Brandeis gave this quote in 1933 as he was part of the Roosevelt administration and the Roosevelt Supreme Court. But this quote certainly harkens back to founding ideas and ideals of the nation, and even previous to the United States becoming its own nation. These classical Republican and liberal ideas stretch back to the 17th and 18th century, and they hold that property ownership is the foundation of citizenship in a democratic society. In the 19th century, federal and state governments went to great lengths, invested lots of resources, and perpetuated a lot of violence against indigenous groups in particular to support white men in acquiring homesteads. So we can think about where we're sitting today. We can think about the Louisiana Purchase. Again, with this idea that citizenship required, citizenship, democratic belonging, democratic participation, all rested in this foundation of property ownership. It's by managing property that one exercises responsibility, that you make determination, you make free choices, and in the practice of owning property, you as a citizen secure your moral and intellectual development, which is essential for preserving your own liberty and participating in the liberty, the democratic of the democratic experience as a whole, alongside fellow citizens. In the 19th century and even into today, people who lacked property or people who were denied denied property rights or security in their property, often, because of violence or because of legal means, those groups that were perceived as sort of being incapable of properly governing, taking responsible care, making good decisions about property. All of these folks were marginalized or have been and sometimes continue to be marginalized, disenfranchised, subjugated. Wage workers, women, African Americans, Native Americans, paupers, vagrants, the convicted, the incarcerated, those who lack property but are also seen as being ill-suited or unable to responsibly steward property. This creates a dilemma in American political culture. So when Brandeis, gave this quote in 1933, he was expressing a real enduring, it was kind of consistent with this enduring impulse to associate citizenship, property ownership, and democracy. But his idea was also kind of signaling a new phenomenon in 20th century American culture. What was different now in Brandeis's day was that the idea of propertizing the masses as a way of securing citizenship and stabilizing democracy In Brandeis's day in 1933, it had become associated with the financial markets. So the idea that that citizenship rested on a propertied foundation, that's very old. But the idea that the type of property, that might provide the foundation of citizenship could be in a financial form. That is very new. That's a 20th century development. So for a century, across the entire 20th century and even until today, Americans have grown ever more entangled with financial securities markets as equity owners, as homeowners who hold a mortgage, and that mortgage, being traded and packaged and traded in financial markets. That's a 20th century story. And state policy, in order to make that happen, to facilitate it, and to encourage it, is something that we need to recognize. So it was not, when Louis Brandeis started his career at the beginning of the 20th century, it really was not obvious that a stock or a bond, an investment account, a life insurance policy, something like that, could could be part of that propertied foundation of citizenship. The family business, the family farm, that's what people had in mind. But when Louis Brandeis started his career, also, stocks and bonds were not part of that imaginary, but they also were kind of insignificant in the American economy in many ways. Stock and bond markets really played little direct role in how the vast majority of Americans saved their money. Less than 1% of the population owned any form of financial security, be it a stock or a bond, something issued by a government, something issued by a private corporation. And for private corporations, financial securities were actually quite peripheral to how most firms raised their money. So when the 20th century started, most Americans judged stock and bond markets as marginal, and if anything, they seemed to be parasitical, they seemed to be dangerous, volatile, not the place where a good, patriotic, responsible citizen would be, taking their money. So Louis Brandeis, the other part of this kind of opening moment that I want to capture for you, Louis Brandeis, comes to prominence in the Wilson administration during the Progressive era at the start of the 20th century, and it's a high mark of inequality. Again, much like levels that have returned to us in recent decades. So. When Louis Brandeis was working in the teens and 20s, we see here this is income inequality, so money that a household would get every year, either for wages or salaries or investments. We see that here the top 1% of households by income, the top 10% of households by income. And, you can see in the teens and the 20s that we're at a high, in terms of how much does the 1% or the 10% get, we're at a high point. And then in the wake of the Great Depression with the New Deal and in the liberal post-war period, property ownership in the form of housing, home ownership, and the ownership of financial assets, that's growing, but inequality actually comes down. In the post-1980s period, we see ownership of those things continuing to grow, but inequality rising again. So, you can have this 20th century commitment on the part of Americans, on the part of their government, to mass investment, but the inequality piece is a little bit varied in the 20th century. So Louis Brandeis and his colleagues are concerned about inequality, and they see the distribution of propertizing the masses, as I said, as being a solution. We can have inequality, say, for example, in income, in opportunity, but if property is widespread, and folks are exercising that responsibility, and they have that kind of nest egg, and they have that property to fall back on. They can still participate in an industrialized capitalist economy without sort of sacrificing their citizenship, which again is grounded in property, or understood to be that way. So inequality is rising. It's high when Louis Brandeis is working, and massive industrial corporations at the turn of the century are rapidly restructuring the economy in a very short period of time. Think today about the big mega corporations that have consolidated in a relatively short period of time. Also, the distribution of goods, think of Amazon, social media, big data, the big Google, data, search engines, et cetera, et cetera. It's a similar kind of moment, the turn of the 20th century and the turn of the 21st. As Brandeis is cutting his teeth at the beginning of the 20th century, these mammoth trusts, these big industrial corporations, which contemporaries called trusts, they propelled a shift from an agriculturally based economy to one that was dominated by manufacturing. And manufacturing, by these big consolidating firms, these big giants. It was both the economic supremacy and the political influence of these trusts that troubled citizens like Brandeis, and so too did their vast fortunes that the founders amassed, which is in some sense indicated on this chart, or if we took wealth and we did the same thing and showed the same curve, this is what Brandeis is responding to. So it's inequality, it's the lack of ownership or the concentration of ownership, and then the way in which that gives the few, the very elite few, a great deal of political influence and power that folks like Brandeis really saw as a big problem for democracy. By crushing independent competitors, these big trusts seem to imperil the long-cherished ideal of broad-based ownership and control of property, at least among white males, which is who held property and managed property at that time. So here we have kind of taking from this moment, right as the 19th century is ending and we're getting into the 20th. This is a very famous painting at the time, very popular. It went on these national tours by a German artist named Robert Kohler. And this scene could be in Minneapolis, St. Paul, it could be in St. Louis or Baltimore or Chicago. These rapidly growing urban areas drawing large immigrant populations that become wage earners who seem to, never have any chance of owning property, but rather will spend their lives working for others. It seems in this picture to be a very diverse group of working class immigrants, and there's this potential for violence. There's the industrialist with the top hat on the stairs, above them. They're very angry. He seems unswayed by their concerns. And we have women and children in the audience who may be imperiled, if violence is going to break out. The city, is exploding in growth behind them, but masked by fog. This huge capital investment of the factory that employs all of these workers, not something that those workers as individuals are ever going to own. So, kind of economic mobility and possibility and opportunity and political power, all of that, kind of concentrated in the hands of the guy in the top hat, okay? So for Brandeis and his contemporaries, a burning desire to safeguard individual and local economic autonomy against economic consolidation, against corporate consolidation, this kind of scene. That concern, that desire, suffused the reform movements of the late 19th century. So Brandeis was a progressive, but we also have populists. We also have socialists who want to do this in sort of a different way by nationalizing or making common, property, especially in big infrastructural property like power plants and transit systems. In one manner or another, all of these groups, all of these reform groups, sought to curb the power of the big corporations, of the super wealthy, and to stymie the schemes of the bankers and the brokers that allegedly, were kind of orchestrating all of this, using financial institutions and markets to create these big industrial colossi. So at this moment, certain progressive economists and reformers like Brandeis get this idea. They suggest that universal securities ownership was the last best hope for American democracy. They felt that if the government, preferably the federal government, regulated corporate securities issuance, the kind of financial disclosure that corporations had to provide to their stock and bond owners, the way that corporations governed themselves, if securities exchanges and banks had to be regulated along these same lines, then maybe it would inhibit or discourage the formation of these big trusts. But moreover, they accepted to a certain extent that given technology, given mass consumerism, that the corporations, were here to stay. And if we weren't going to nationalize them, then the best thing that could be done would be to provide all of this truthful and adequate information that a properly designed regulatory system could ensure, and allow Americans they would then be able to safely acquire a political and economic stake in the corporate economy, their share of it, in the form of a corporate stock or corporate bond. So mass investment in financial securities could shore up the propertied foundations of citizenship, preserve economic mobility, autonomy, security, make corporations accord with the will of the public that would own its shares. The option, what were the other options? Otherwise these wage workers and, white-collar managers would just be wage slaves, for the rest of their lives. But if we could break up the ownership of that plant, if we could sell them shares in that corporation, then, perhaps the man in the top hat, would come down a bit down the stairs, and there would be a sense of partnership and stewardship together. So universal investment would equip the citizenry with tools of political independence and social mobility, diminishing the allure of radicalism, more radical proposals, which are sort of expressed and depicted here as the sort of simmering potential for violence. So, as I said, what's distinctive, from the turn of the 19th, 20th century for the next century until our own day is, first of all, that financial securities are conceived as legitimate property and desirable, for citizens in a democratic capitalist country. The second thing over the course of the 20th century is the sense that the federal government has a role to play, whether in encouraging, supporting, protecting the investments of its citizenry, whether that is through regulation, through insurance, through active various ways of acting in the financial markets. It's a desirable thing, and it's a thing that the government should support and encourage. So at the beginning of the 20th century, as these ideas are just getting off the ground, they're rather, from a historian's perspective, really novel, really unexpected, because, as I was saying before, the stock and bond markets played little role in how the vast majority of American households saved money. Less than there we go, less than 1% of the population owned a financial security in 1900, whether it was a bond, whether it was stock issued by a corporation, issued by a government. Financial securities were largely peripheral to how firms raised capital and seen as parasitic. So here's a couple images of kind of what this looked like in the popular imagination and, kind of popular culture. Here we have J.P. Morgan, the great financial titan who did, orchestrate a lot of these big industrial mergers at the 20th century. And we see this group of, everyday Americans, average Americans, ranging from the working man, the widow, the, woman, the middle-class gentleman, or middle-class man, et cetera, and the bull figure, the Wall Street figure of the bull, who is J.P. Morgan. He is blowing soap bubbles, playing and toying with these, diminutive small investors or average citizens. There's a stock ticker in the middle. And the bubbles, you can't see it very well, they're labeled inflated values. And what that's referring to is the prices of the shares, of the stocks and the bonds of these new industrial corporations, and any small investor, who's going to reach for those and acquire them, they're going to pop. They're going to explode or pop in their face. The bubble's going to burst. This is all just a game. It's a game, being perpetuated by J.P. Morgan against this group of average Americans. So, it's kind of a joke. It's something that average citizens shouldn't really be involved with. If the bubble bursts on them, that's their fault for playing the game in the first place. This is a kind of similar moment, similar episode. Here, though, is depicted Andrew Carnegie, who was one of the steel titans whose company became part of U.S. Steel. And this is a specific example of a case in which J.P. Morgan, consolidates using financial markets, using financial securities, consolidates steel companies into the U.S.'s first billion-dollar corporation. And we see the figure here of the small investor in the form of the lamb. So you have like the bull and the bear and the lamb. And, the lamb is sort of a ridiculous figure, a silly figure, a foolish figure. And again, if they're going to get involved in trying to play this game, buying the stocks and bonds of a big corporation like U.S. Steel, they're going to get bowled over. They're going to get hurt by this. It's not a place where they belong. Wall Street, this whole street is being cleared out by the ball coming down the sidewalk or runway or alley or whatever that is supposed to be. So at 1900 or thereabouts, no one could kind of conceive that this lamb figure, this small investor figure, was going to be such a kind of valorized, such an important figure. Such an important ideal. It seems incongruous at this moment in time. But, as I said before, there are some progressives, like Louis Brandeis, who begin to imagine that actually we could democratize corporations if we actually empowered these lambs, if we gave them the right information, if we were honest and open with them, if they weren't sort of cheated and swindled by bankers and brokers, we regulate those industries, then the securities markets, Wall Street, could be a safe place for these lambs where they could acquire their stake in industrial capitalism. But this is all kind of a rhetorical debate, and it's really a debate about sort of something else. It's about the regulation of corporations and the regulation of financial markets, with this progressive side saying, let's do this and it will have this effect. In response, the kinds of institutions who are under threat of regulation, according to this this new theory of mass investment, they don't like this idea very much. They don't want to be regulated. They don't necessarily want to be doing this business. They're perfectly aware that the average American really doesn't have that much money to invest in the first place, that they can draw a lot of regulatory scrutiny and a lot of criticism when they lose their money. So the New York Stock Exchange, in the decade or so before the First World War, as this ideal of mass investment is getting underway, the New York Stock Exchange responds by saying, no, thank you. We're actually a perfect sort of financial economic democracy already. We, on the trading floor, we're executing the trades of Americans from all over the country, or the institutions like insurance companies and banks that hold their savings. State regulation would just be too clumsy, it would be inefficient. You know, the work that we do here on the trading floor, it generates the prices of securities. Those prices direct the allocation of capital. And, you know, there's no speculation here, there's no gambling here, we're not hurting anybody, but we're experts playing this important role. And, you know, the collaboration that we have generates something that's democratic anyway. We don't need any kind of further attention from, you know, would-be regulators or progressive theorists. So again, even before there is the phenomenon of mass investment, there's already this debate between a progressive view of mass investment and a more conservative view of that mass investment. One saying, let's regulate corporations and the financial system to encourage and support small investors, because that will really help re-democratize the American economy. And the other voice saying, the more conservative voice saying, yeah, we got this covered, you know, like we're doing fine just on our own. So it isn't until World War I that we get anything that looks like actual mass investment, right? And so when mass investment sort of takes off, it's not stock ownership, it's bond ownership. It's ownership of the bonds the federal government sold to fund World War I. So in World War I, fantasies of mass investment materialized for the first time. 82% of households pledged to buy a federal war bond. 32.2% of the population participated in the war savings program. The Wilson administration chose to fund the war this way through the sale of these small denomination federal bonds because it viewed mass investment as a means of encouraging and making evident support for the war. The Wilson administration believed that mass investment in war bonds would unify a heterogeneous population, a population that didn't vote, a population that was perhaps opposed to the war, but they still needed to get money, raise money from them. It viewed it as a means of inhibiting inflation by sort of sopping up high wartime wages and putting them into these securities. And the promise also was this would ensure a better, more democratic, less volatile, healthier, more robust post-war economy. The War Loan Organization sort of took from Brandeis and his colleagues this idea that mass investment, or individual investment by the masses, would make every inhabitant of the United States into a citizen investor, even if they did not have the vote. So it was akin to voting. Buying your bond is akin to voting. Voting for America, voting for Wilson, voting for democracy, voting for capitalism, voting for the war, even if you didn't get to vote at all. Even if you voted, but you voted against Wilson, you were now voting in favor through the bond markets. So for these war loan, kind of architects, citizen investors could possess a stake in the nation even if they lacked the vote. This is a moment that is marked by passionate debate over the meaning of citizenship, who is entitled to citizenship and which rights, women, suffrage, challenges to Jim Crow. It's a moment of pervasive paranoia about radicalism with the Bolshevist Revolution. It's sort of a high point of socialism and communism in the United States. It's a high point of organized labor. In the context of all of this, the war loan drives imagine investment as an act that could both manifest and make citizenship. So here we have this cartoon, this is produced in World War I, and the caption on this is actually Boardroom USA. So the nation is being portrayed as, a corporate boardroom, and these are all of the directors. Every citizen of the United States as a bondholder is akin or equivalent to being a stock owner or even a director in this corporation USA, and Uncle Sam is the CEO. And he's discussing, he's engaging, and these guys have their, disclosure documents, and they're, actively engaged in a mutual conversation or collaboration about the fate of this enterprise, which is the United States in general, not specifically the war effort, but the nation as a whole. Treasury Secretary William McAdoo, who oversaw this operation, recollected later, the problem would have been hopeless if we had not had the willing cooperation of an army of volunteer salesmen. Keep in mind, the federal government is really kind of thin on the ground at this moment. So it's not the government itself that mobilizes citizens' dollars. It's the associations of private civic life. Yes, banks and brokerages, corporations, employers, are kind of trying to get to the average American to buy bonds, offering them credit, because even though the denominations, $50 bonds is still pretty expensive for a working person. But really, it's the groups that organize private civic life. So churches, suffrage and anti-suffrage groups, labor organizations, African American associations, ethnic associations, the Girl Scouts, the Boy Scouts, institutions of this nature. So citizen investors really mobilize themselves to sell these securities to one another. And this is another reason why the sort of rhetoric of the war loan drives and the pageantry of the war loan drives is so capacious and so flexible. In this moment, these war loan drives inspire a variety of ideas about what a mass ownership society means exactly, what it is going to look like in the post-war period. So in the immediate post-war period, the progressives and rail unionists step up and say, let's do this to the railroads. Now that we've funded the war effort through more mass investment, let's have the federal government buy out the entire railroad system. And they'll do that by issuing bonds that'll be bought by citizens, like they once bought war bonds. And that money will buy out all of the railroad owners. And that's democratic capitalism. We bought out the state, bought out the underlying infrastructure, the most important infrastructure in the country, which at the time is the railroads, and then the rest of the economy will be free. And every citizen will sort of own the railroads because they own these bonds. They've bought it themselves, okay? So that's one idea. Citizen investors bought up bonds that were issued by federal, state, and local governments in the post-war period. These governments, the soldiers' bonus, at the federal level, but at the state and local level, these sub-national governments are creating programs for workers' compensation, maternal and infant health care, various infrastructure projects, as I said, pensions and bonuses for soldiers, but also mothers and the elderly, the subsidizing of farm mortgages. All of this is, in many states and localities, it's done by a mass bond sale, and then again, using those proceeds to start these kinds of programs. Lastly, the federal government continues to sell some small denomination savings certificates until 1924. It remains a popular program to invest with the federal government by buying, these kind of small denomination instruments. So Couple illustrations here to show you. Here's a good example. This is a kind of suffragist organization that published, this ad and many others. And they're saying women are citizens when they support their government in the time of war by buying and selling Liberty bonds. And the text, which you can't read so well, makes some statements about how, this is the way that we can prove and demonstrate our citizenship, but also make ourselves citizens in the fullest sense, because then after the war we will have won suffrage, or this will be another claim that we can make for the right to vote. This is a cartoon that was published during the Spanish flu pandemic, in which the securities of the federal government are inoculation. Uncle Sam's giving it to Lady Liberty, giving it to democracy, and they're a vaccination against what's going on in Europe. What's heading U.S. way from Europe, which is Bolshevism, hunger, famine. The idea being that if citizens had this sort of propertied stake in the form of a financial security, they wouldn't be susceptible to these things. They'd have something to lose. They'd have a stake in the system. Marginalized groups like the Chinese. This is a Liberty Loan pageant in New York City. And while the home front during World War I is marked by 100% Americanism, violence against Germans, and other expressions of sort of ethnic particularity, here in a Liberty Loan pageant, Chinese American children are dressing in native garb, marching in the street, proclaiming that China has incorporated. It's a new America, and that's a statement and a performance that they can, safely make in the streets of New York because it's part of a Liberty Bond campaign, and it's demonstrating that their ethnic heritage need not be inconsistent with being American, but so long as they own Liberty bonds. The pageantry and rhetoric devised by African American groups actually voiced demands for civic inclusion, political rights, the destruction of Jim Crow. The editor for the Savannah Tribune, a black newspaper, envisioned that, quote, the Great War savings and bond campaigns would deliver, quote, vast wealth and improved economic and industrial status to African Americans, reshaping, quote, the hierarchy of groups and abolishing race troubles and friction and oppression. Excuse me. Little tickle. So again, keep in mind that Wilson had pledged to keep America out of war when he got reelected. The administration has dire concerns about inflation, about the criticism of its war finance and sort of economic management strategy. Many Americans, Irish Americans, German Americans, don't want to be at war at all. So the War Loan Organization is pushed to defend securities investment in general, not just as something that you need to do as a patriotic citizen to win the war, but as investment in securities as a set of attitudes and practices that would yield a better future for individuals and for the nation as a whole, even after the war. Financial securities in general were promoted as tools of individual economic freedom, instruments of economic prosperity and stability for America as a whole. This is the war savings program becomes the government savings program after the war, and you can see here a home, a business, let Uncle Sam help, the idea that, investing in securities, and here continued the securities of the federal government, can be this stepping stone in which, you can prosper, you can advance as an individual, as a family man, as a family, as a modern family. Okay, so war loan publicity, imagery, and spectacle fixed these associations between investment in citizenship, securities markets, and political democracy. Prior to World War I, no one would have imagined, except for these couple progressive thinkers, no one would have imagined that the financial securities markets were doing anything good for democracy. They were instruments of, disgusting levels of like wealth, and which then perverted the political process. They were instruments by which these large industrial corporations rose up and crushed independent proprietors and enslaved waged workers. So it's World War I and the federal government itself suggesting this association. Even so, as I was saying before, it's not foreordained that these new citizen investors who bought war bonds would then suddenly flock to the stock market in the 1920s. So what happens? There were all of those other progressive ideas, the Plum Plan, the social welfare policies funded by mass bond drives, even the Treasury Department's US government savings programs. The banking lobby kills that program. So that's what happens to that one. But in terms of why do citizen investors flock to the stock market, it's not because in the 1920s, American corporations needed their capital. In fact, they don't have that much capital to contribute. If you're gonna, in the 1920s, and this happens throughout the 20th century, if you're going to have encourage an average American to make a major investment in an asset, whether that's a portfolio of securities or whether it's a home, they're gonna have to borrow money from you, right? And so most corporations and financial institutions don't wanna be involved in that. So it's not that corporations are getting a lot of money for expansion from these investors, and it's not like banks are really all that desirous to do this kind of business or brokerages. It's actually political concerns that animate a host of projects to change public thinking about the stock market by corporation, public thinking about corporations by universalizing stock holding. So first corporations and then financial firms in the 1920s sought after mass share ownership to buttress their assertions that privately administered corporate capitalism best served the public interest because stock owners were the public. So in the immediate post-war period, I told you about some of the proposals that were floating around, but corporations, in addition, US corporations were facing intense labor unrest, extensive unionization, unwelcome regulatory bills, and even proposals to nationalize existing infrastructure and to build new large-scale public infrastructure. So like AT&T's under major nationalization threats. Most of the privately owned telephone and telecommunications infrastructure in other, kind of industrialist countries does get nationalized after World War I. And some of this, it's not unlike ideas that are floating around today with the infrastructure bill and whatnot. So in response to these kinds of proposals and labor unrest, et cetera, hundreds of corporations in the 1920s sought to improve political relationships, their public opinion, by distributing stock directly. Sorry, my page number's a little messed up here. What did I do? Directly to their employees and to their customers. In the middle of the 1920s, financial firms then followed, extending a lot of credit, creating new financial products like investment trust shares, which are kind of like mutual funds, and then again, granting billions of dollars in credit so that average Americans can acquire stocks. By 1929, an estimated quarter of households own shares in American corporations. Jazz-age corporations, banks, investment trusts, and brokerages all told stories that were about the promise of mass investment that sounded and looked incredibly familiar because they referenced tropes that had been developed in the war loan drives. So whereas the nation, the wartime nation, had been a corporation, now the corporation is a democracy or a nation, a democratic nation itself. So AT&T is a real pioneer in this. They have these big programs to try to get customers and employees. They have so much money. They're not getting money from those investors. They're actually giving money. They're lending money to those customers, employees, because they want them to acquire their stock. And they, kind of have partial payment plans and stuff. So you see this rapid rise in the number of investors, especially after the post-war period, in order to try to quash proposals to nationalize AT&T. And in their public relations, they're figuring that body of investors, that over 250,000 they're claiming investors in AT&T as this kind of country in and of itself, and AT&T is like a little democracy of stock owners. So corporate stock promoters figure themselves as a democracy of shareholders, America as a nation of stock owners, the stock market as an analog and an instrument of political democracy and economic justice. The idea here, the idea of a shareholder democracy, is that union membership may be declining, inequality may be rising, but through stock ownership, Americans can nonetheless achieve old age security, class harmony, economic stability, corporate accountability in a democratic manner. They urged at the same time that American shareholder citizens renounce regulation, the welfare state, as an agent for managing risk across society, and they rejected the idea that citizen shareholders would benefit from any kind of state oversight. This is marketing from an investment trust, which is like a mutual fund. It buys up a wide range of stocks and bonds in a wide range of corporations, and then if you buy a share in the investment trust, you sort of have, a slice of it. So figuring, that portfolio as a share in America because of that, wide distribution or diversification. In World War I, there was a kind of marketing trope called back of it all that featured sort of the industrial might of war production with the worker, the union worker even, being the kind of linchpin, being back of it all. And, he deserves that you buy the Liberty Bond to make the war successful and keep this machine going. He himself, acquires one as well as part of his, action as an agent and a part of this kind of wartime machinery. In the post-war period, and here's Uncle Sam, being shown as an important, figure, a commanding figure in that economic mobilization of America's industrial might. In the post-war period, this back of it all trope actually replaces the figure of the worker and of Uncle Sam with the investor and the investment advisor. So now it's by buying bonds and buying stocks in private corporation that you sort of, there's kind of mastery over the industrial economy, participate in it on this solid propertied footing. Now, of course, as we all know, it all ended badly, right, in the crash of 1929. But something that's really important, I think, to take away from the talk, let me go back to my shareholder data, my percentage of households. Okay, so what we see this kind of little blip. The 1950s number, 52 number, is a bit of an outlier because Americans really sell off stock holdings so that they can buy war bonds again. So if you take that one out, you'll see that things decrease a little bit in the 30s, but you stay pretty steady at this quarter of American households until the 1980s. So mass ownership mass investment in corporate stock has remained a pervasive feature of American economic and political life down to this very day. What happens in the 30s is, Louis Brandeis and his ilk kind of win out, that sort of more progressive voice, that more progressive version of investors' democracy, where you need to have, a government presence regulating to a certain extent the participation of small investors in the stock market. In the post-war period, things are going to shift more to home ownership, and the federal government is going to get very involved there in the mortgage market. But of course, this is done in a way that excludes African Americans and builds the white suburbs. After the beginning in the 1980s, again, we're going to see an uptick in share ownership and housing ownership again in the 1980s and 1990s. And that's because of new kind of tax policies that are written to encourage, the defined contribution plans, the 401k and IRA accounts in which most Americans, that's mostly the way that Americans save money in the stock market. But again, this is done in such a way that it's going to leave out Black families. So, this ownership frame, this commitment to using the financial securities market to promote the ownership of assets among American households is been a story that stretched all across the 20th century. There's been conservative variants, there have been progressive variants, but whichever one it is, it's always sort of been at it's always left or significantly been disproportional to white households versus Black households, and it generating the wealth gap that we have today. So in conclusion, if I can find my final page here, sorry. As I said, my pages have gotten a little bit mixed up. Well, so let me say in conclusion that this ownership frame has very much, which has included financial securities ownership in the 20th century, it has really, whether you're on the progressive or the conservative variant, it has most of the time constrained the scope and scale of kind of what we can imagine by way of reform, by way of government action, by way of what's sort of possible to imagine in terms of what American capitalism should and ought to be. Questions about the distribution of economic power, wealth, and risk across society have sort of fallen by the wayside. And it's only in moments where social movements rise up to really press on those issues that the ownership frame and the ideal of a mass investment society, has that we've been able to see it in a skeptical sort of way. So Occupy Wall Street was one such moment, Ferguson another, Minneapolis after George Floyd, and maybe the COVID crisis now. So whether it's time to retain the ownership frame and take it in a more conservative or progressive direction, whether it's time to question it and rethink it wholesale, is something for democratic deliberation in our own moment. But I hope history can help us to see that those questions have been answered successfully and unsuccessfully in many different ways in the American past, and that may offer us some tools and some inspiration for thinking about our future. Thank you.
Excellent. We have time for questions. If anyone has a question, you want to raise your hand, I'll come find you.
Very interesting, and I have to think faster than you talk, so it makes it a challenge. Can you tell us anything about the proportion of Americans who are now placing some of their funds in the stock market versus major European countries?
I don't have figures off the top of my head on the comparative. I can tell you that I think the number is like 53% today of American households have money invested in the stock market, whether that's because they directly own a share of Apple or Facebook or what have you, or whether it's because they're investing in a mutual fund, or whether they have some kind of retirement tax advantage retirement portfolio at work that is invested in stocks or stock mutual funds. So it's remained relatively consistent. We've seen in the financial crisis and the COVID crisis, people need to liquidate and things bounce around a little bit, but persistent around 50%. But that metric of exposure, or that metric of ownership, it really masks the discrepancies across the income and wealth ladder in terms of who really owns and benefits from stock ownership the most, and that's the richest 10% or even 1%, which is a almost exclusively white population. So the extent of stock ownership is one thing. The sort of how should I say it? How much it means to any given stock-owning family versus what their housing or job situation, that's something entirely different. In comparison to other industrialized countries in this moment and throughout the entire 20th century, the United States has been very, very distinctive. There have been moments in other national histories, I was mentioning in the previous talk, Chile, they privatized their social security system in the 70s and kind of gave the money back to individual households to invest in the Chilean stock market. This was under Pinochet, where you had Milton Friedman and the Chicago Boys advising that government. And Thatcher, did some of this stuff, privatizing a lot of stuff, during her administration, and then some subsequent conservative governments. But usually what happens in these scenarios, and we can think of sort of post, communist Russia, usually what happens in those scenarios is pretty quickly the ownership of those shares concentrates in the hands of the very few. So the extreme example would be like the crony capitalism under Putin, where all of those nationalized industries, immediately get bought up by his cronies, and it's a fiction that they were ever really publicly traded or publicly owned in the first place. So in terms of this, at this moment, America is well above, other nations, and it really has been across the entire 20th century.
I was wondering, during the years when they were excluding black families, what kinds of tools or what were the major ways they were able to do that?
To do the exclusions?
Yes, and then about women, when did they start, playing a part in the system?
Well, so women are I'll start with that one first. Women are an interesting situation. We may have an idea now that, owning stock or playing the stock market or whatever is sort of a boys' game, or maybe it's not now, but usually it had been. The truth of the matter is, I'll go back to the 18th century, like Abigail Adams loved speculating in the stock market. And the reason this is, and she's sort of indicative of wealthy women in the 19th century and even in the 18th century, the idea here is that women could, even though generally speaking they have no economic rights, and if they have property and they bring it into the marriage, or if they inherit property, it's their husbands and their husbands control it. There are, for some wealthy women, some possibility of setting up like separate trusts. And they have to be under the oversight of like another man, brother, uncle, father, whatever. But for the few women who can do that, they're not buying their own farms or starting their own businesses. So if they have a little pot of separate money, speculating in the securities markets, makes kind of practical sense for them. So women have sort of always been in the security market. The question is like, what kind of woman doing what exactly, right? So, but what you find by the time you get into the 20th century, and women are no longer under coverture. They have even married women have like their own property rights and stuff like this. What you do find is women outlast men. So you always have kind of a class, throughout this entire sweep, a heavy presence of women in the stock market because they've inherited a stock portfolio from their husbands upon their husband's death, and they're owning, and maybe they're very passive, or maybe they're not. But, gender may be less of a feature than other kinds of demographic factors. Now, for African Americans, this is like largely just completely irrelevant for most of the 20th century because there are no African American families, or like statistically virtually no African American families with the kind of disposable income that they're going to have a stock portfolio. And in fact, when I've looked at the Fed data for the 1960s, the demographic, like the top 10%, of wealth holders in the country in that year, which is where most of stock ownership is concentrated. So the top 10% by wealth tend to own, depending on where you are in the century, it's like 70 to 80% of all corporate stock. It's pretty highly concentrated at the top of the income distribution and the wealth distribution. If you look at even as late as the 60s and 70s, we couldn't find one black family in that sample, not a single one. And that didn't mean that there were no black stock owners. It means that out of the 50,000 families that the Federal Reserve sampled, they couldn't come up with one. And you can't really say, okay, well, so it's to that extent. So African American families need to be able to amass enough in terms of inheritances or in terms of income and savings so that something like stock market investment is even viable. And some of that is happening, so you need to have anti-discrimination statutes and sort of in labor markets and housing markets, right? Like all of that stuff has to change before, across the entire population. One individual, you could always argue, but if I'm talking broadly speaking, you have to have those things change before African American families, generally speaking, are gonna have any hope of doing this. And today we see, even if you look at the wealthiest African American families, you take the wealthiest African American families and the wealthiest white families, and then you look at what they're invested in, and the prevalence of stock ownership, even a very wealthy class of people, black and white, is going to be so much less in black households than in white households because they just don't have that generation of accumulation, right? What you get in the 1980s, you get a little more black stock ownership because, for the same reason that, we get this uptick after 1980s anyway, there are some tax changes that encourage Americans to get into the stock market in one way or the other. And you guys are probably familiar. These are things like 401k plans and IRAs and stuff like that. So the idea that you can save money on a pre-tax basis, that helps. Right? So, if you're in a situation where you get taxed and then you're paying your expenses and then what do you have left over to put into the stock market versus you get to take your savings, you get to take that tax-free retirement, put it into a portfolio, put it into an account, it's professionally managed, so that's happening to everybody after the 1980s, and that increases the amount of black families, who can participate. But again, you see a similar situation where even if more African Americans are participating, so much less, they have so much less, in dollar terms or in relative terms compared to whites. The last thing I'll say, because it's financial, when I talk about this ownership, I also mentioned housing. So when the federal government, with the New Deal and the GI Bill of Rights, when they get into the business of encouraging Americans and helping Americans to buy their own homes, I'm sure many people are familiar with how this works, you need a mortgage, right? That's why home ownership was not widespread before the 1950s. You need a mortgage, and if the federal government guarantees that mortgage, then you are going to be much more likely to get a mortgage from the bank because the bank says, this is great, the mortgage is guaranteed. I have no loss, no possibility of loss because the federal government's going to cover it for me. And this is what Ginnie Mae and Sally Mae and all those guys do. Well, for the first several decades of those programs, again, if you go back to the data, you can barely find, 1% of all mortgages in the entire country are given to black families. And the reason for that is redlining, which is a term many of you may know or you've heard of before. The federal government, the FHA, had these maps, and they wanted to, in the 1930s, 40s, 50s, they want to stimulate the construction industries, they want to keep people at work, they want to create jobs, they want to keep the economy growing, and they say, we don't want to guarantee mortgages in cities because that's old housing stock. We want people buying new homes in the suburbs. Some of it goes to this property ownership ideal, you're gonna have land, you're gonna have fresh air, you're gonna have your kids, you're gonna have your car, you're gonna have your new appliances, right? So some of it's the ownership, citizenship thing. Some of it is ideas about, robust consumer demand driving the economy. But those red line maps, the red lines are going around the inner city neighborhoods where the housing stock is old, and they're not eligible for those loan guarantees. So African Americans who stay in those redlined areas can't get a mortgage to buy maybe the house that they're living in or the house that they'd like to buy, whatever. But they can't go out to the suburbs either, because either it's legal in the 40s and 50s, it's legal to discriminate. You can say, like, this house, you can have it in the contract that it can't be sold, or just it still happens today, like informal discrimination, keeping people residentially segregated. So what happens with that is that, you have a good generation, at least, if not two, from the 30s until like the 60s, where the federal government, because of its unwillingness to guarantee mortgages in places where Black people live, right? The white people who are getting the mortgages out in the suburbs where Black people are not allowed to live get this kind of generation push. For one generation, they're able to acquire a home and build equity through home ownership that's not available to Black people. And so, it takes the civil rights movement, to pass the legislation about sort of, no discrimination in lending, no discrimination in, residential sales, all of that kind of stuff, to even begin to make a dent in that. But of course, we know it's still, you can make it illegal, but people can go into a bank and you go talk to a broker, and if that person is discriminating on the basis of race and they're not stupid enough to say it to your face, it's very difficult to bring a claim, or get some kind of justice. So, that's still a phenomenon that exists today.
Hi, thank you for your talk. I'm interested in what you can tell us about the age distribution of equity ownership. Let me say first that you would expect that there would be a life cycle component to this. So naturally, baby boomers like me, are going to have more stock ownership than younger people. But my perception is that the debt that young people, say college age or up to, say, age 30, are carrying now means that they too have so little disposable income that, although I don't know this to be true, I think it's probably the case that their equity ownership is minimal.
Yes, I think you're exactly right.
And following your thesis, this may be partly why we perceive that people of that age feel disenfranchised and alienated from American capitalism.
Yeah, and I don't think it's impossible that it's not just that we perceive that they are, but they are in fact, and that previous generations of folks in their 20s and 30s who were better situated to get a good job, that allowed some program or some mechanism, whether it's because they have more disposable wages or the company has some sort of stock option, whatever it is, but also more able to acquire a house and all of the other things that have been historically part of this citizenship as ownership, in the 20th century. I think that's definitely true of this generation. I can't quote numbers, off the top of my head. It is always the case, for as long as we have data, that stock ownership, whether it's direct or indirect through an entire retirement count, it's always more prevalent in, households that are, between the ages of like 45 and 65. It always kind of concentrates there. After that, households are going to sell stuff off because they're in retirement or they're gifting or, buying a second home or what have you, if they're that affluent. Below that, people are taking care of buying a car and they're buying a house and they're, raising their children. So they don't, they're not going to be able to acquire a big stock portfolio, or if they've got, again, look at this chart after the 1980s, if there's a tax beneficial way to set a little bit aside, which is what we have today in 401k accounts, then that demographic might start doing that in a small way. I think, though, you're exactly right, that if you look at those younger adults, Since the 401ks started, since those kinds of programs existed, and you were just looking at people in their 20s and 30s, who were fully employed, let's kind of take the unemployed out of it, that those, quote unquote, well-employed younger households are less likely to have stock, direct or indirect equity ownership, also less likely to have a home, less likely to have health care, less likely to have a lot of things. I think that is certainly true. And I think it's certainly true that is an effect, it's not just a cultural effect, like it's not hip for this generation or something. It's an effect of all of those other things, and I think that's true of, I'm teaching this generation right now, and everything for them is delayed. Buying the house, starting the family, getting married, having kids, stock portfolios, like forget it. I don't even care if I get there. I just want like the trappings of an independent, household and not be, dependent on my parents or what have you. But that generation has also lost, they've lost the kind of jobs that would even give you a 401k option, much less the means to contribute it to it. So this generation of young people are working in precarious jobs, 1099 jobs, the kind of jobs where, not only are they not making contributions to their retirement, but their employers aren't making contributions to their retirement. They're not getting health care through their employer. Their employer may not even be paying, like the payroll and the Social Security taxes. Like they don't even have that stuff. So for this generation, like the more limited and suppressed level of equity ownership is just one issue, right? In terms of what young people are facing today. But it's a good point.
Well, thank you, Julia, for traveling all the way here to Minnesota today
It's my
on the cusp of
pleasure.
our first winter weather event.
Thank you so much for coming.